at this, and you have to go ahead and accept that. I do want to record this meeting for my purposes. Okay. And if we're looking here, we are in the best case scenario. We are believing that the financial statements have been prepared in accordance with the generally accepted accounting principles. We're satisfied. We are happy with these financial statements. Okay. Now, in the case of a non-public company, we call that unmodified. In the case of a public company, we call that unqualified opinion. We'll be taking a look at the way these different opinions look here in a little while. Now, what happens? If we are looking and we find that the company did not follow the accounting standards, then we're on this side of the little chart here, and we must have gap issues. So if that's the case, and we start to feel that there's some problem with the financial statements, our face goes from happy to sad, because now we have found some problem with those financial statements, the way they prepared them, and we're going to be calling that out in our report. We're going to be looking how that report will be changed from the unmodified, unqualified to qualified if we have some problems. If the problems go from bad to worse, okay, just to keep using this technical drawing here, now the auditor is crying. Now the auditor is saying, hey, these financial statements do not follow the generally accepted accounting principles and should not be relied on. Okay. And notice that our problems go from no real problems to very material and pervasive problems. Now, you look at this and you're like, well, John, can you put this in some sort of, real terms that I can remember easily? And I tell you, yeah, okay, let's use this as an example. Let's say you have a friend and the friend says, hey, I want you to come over and I want you to look, I'm going to have a job interview tomorrow. I've got a suit, everything ready to go. And I want you to come over and see if you think the outfit looks okay. So you go over to their house, you come check it out. They come out in their outfit. They nailed it. Suit, shirt, tie, shoes, socks, nailed it. You say, I don't know how well you're going to do in the questions, but on that outfit, you should get the job. Okay. And so what happens? You just gave them an unmodified, unqualified opinion on their outfit for it being appropriate for that job interview. Okay. Now, let's say your friend comes out and you get down to the shoes and they're wearing a pair of Air Jordans. And you're like, well, what shoes are you going to wear? They say, oh, I'm going to wear the Air Jordans because that's in or something. You say, no. You can't wear Air Jordan to a job interview. So you give them a what? Qualified opinion. You say, I believe that your outfit looks good, except for the shoes. And you call out what the problem is. And the shoes are a material issue there. I mean, that will potentially cause them not to get the job, right? Because they're wearing Air Jordans. So you're calling out, I like your outfit, except for, you qualify it, except for the shoes. Okay. Now, adverse opinion, your buddy comes out and they come out in a whole sweat outfit, nice sweat outfit with the Air Jordans, but not a suit, not an appropriate interview attire. You say, that's what you're going to wear? No. If you wear that outfit tomorrow, you will not get that job. In fact, they may not even let you in for the interview. Security is going to stop you at the door. So you just gave what? An adverse opinion because there's so much wrong with that outfit that you say, no, you cannot wear that outfit. Okay. So unqualified, everything's great. Qualified, we've got some problems and they're pretty important problems. Adverse says no. Users, you cannot rely on these financial statements. Okay. Now let's go on over to the other side and let's look at gas issues. Okay, gas issues. Now what happens? Well, we are doing our audit and there are some procedures that we cannot perform. Okay. And if those procedures are fairly important and we can't perform them, the auditor, and notice we use the same word here, guys, the auditors will qualify their opinion. Now they're qualifying it because the auditor was not able to complete the full measure of the generally accepted auditing standards or the PCAOB standards. If we're talking about a public company, we put PCAOB here. Okay. And so the auditor goes ahead and qualifies the opinion. We'll see what that will look like here in a couple of minutes when we start looking at the details of these reports. Now, If we are sitting here with a disclaimer of opinion, and I'm not going to put the mouth on the auditor, I'm simply going to put the auditor shrugging their shoulders or doing this. The auditor says there were so many procedures I could not perform that I don't know if the financial statements are fairly stated. Okay, now, when you look at this, this is usually something very big. For example, let's say your client has a major subsidiary. Okay, so you're auditing the consolidated financial statements. The client has a major subsidiary, and the subsidiary's financial statements are not audited. Well, now you're taking unaudited information and trying to bring it into what is supposed to be consolidated audit, and you say, no, that is too big of a chunk of this thing that did not get audit scrutiny. I am going to disclaim an opinion. Okay. Now, let's go back to the shoe example. Okay. So what happens? Your buddy comes out, beautiful suit, everything's great, unmodified, right? Going over to the gas side. Your buddy comes out, everything looks good, but when you get to the shoes, they're not wearing any shoes. Nice socks, no shoes. And you're like, well, what shoes are you going to wear tomorrow? And they say, oh, I'm going to pick up the shoes on the way to the interview. You say, okay, then your suit looks good, except for what I would have been able to tell you if I had seen your shoes. Would I be able to tell you about those shoes? Because you were limited in what you could tell about their shoes because they were wearing them that day. Okay. Now, disclaimer, your buddy calls you and says, I want you to tell me how my suit looks for my interview. My outfit looks for my interview tomorrow. And you say, okay, I'll be right there. No. Your buddy says, don't come over. Just tell me from the sound of my voice, how do I look? Well, you would disclaim an opinion. You'd say, I can't give you an opinion. I have to see what you're wearing in order to give you an opinion. So when the auditor's procedures get so limited that they aren't able to give even a qualified opinion, they go to disclaimer, and the auditor is saying, I don't know. I don't know if the financial statements are fairly stated. Now, when you look at this chart, guys, okay, in the real world, you might see, generally you should see this. You might see some of this. You probably would never see something like this. This is highly unusual because most of the time, if a company has that many problems with the financial statements, the auditor would have worked with them to make the necessary adjustments so that they're moving back towards a qualified or maybe even unqualified, unmodified opinion. We can work with them to get them to correct the problems that we have. So it's rare that a company would have so many problems that they didn't want to fix them, and we would end up in the adverse world. Okay. Disclaimer, okay, is not seen very much, but it could be seen. Okay. And in the case of a disclaimer, I don't know if I should put a check there or what, but it can be seen. In the case of disclaimer, if you can't do the necessary audit procedures to get the evidence you need to support the financial statements, then you can't get the evidence. Classic example from my personal experience in the years that I worked with GAO, we disclaimed. I was an auditor with the Government Accountability Office for 26 years. I was on the consolidated financial statements of the federal government, and every year we disclaim an opinion, and they continue to disclaim an opinion on the consolidated financial statements of the federal government. Why? Well, one is nobody can audit Department of Defense. Now, when I tell you that nobody can audit Department of Defense, you think, oh, why? Because of national security issues? No. The Department of Defense is good at blowing up other people's assets, but they aren't good at keeping track of their own assets. So what happens when the major subsidiary of the federal government, Department of Defense, gets a disclaimer on their financial statements? That bubbles up into a disclaimer on the consolidated financial statements, just like what I was talking about. If you had a major subsidiary of a client that couldn't get an opinion, that may bubble up into a disclaimer on the consolidated. The other reason is that the balance sheet doesn't balance. The federal government's balance sheet doesn't balance. The reason is that they have this consolidation system that basically prepares the consolidated financial statements and then tries to back them into the 32 agencies that constitute the consolidated financial statements. And I'm here to tell you that never works. That doesn't work in government. That doesn't work in industry. Consolidation does what? it goes from the bottom up. Unfortunately, you've got 32 different systems preparing the agency statements, and they're not able to reconcile that to the consolidated system. And therefore, there's about a $4 to $3 trillion plug that happens on the balance sheet every year. And as the auditor of record, the GAO has determined that that warrants a disclaimer of an opinion. Okay, so I'm pointing this out so that you can see the nature, the magnitude of things that are going to cause a disclaimer. They're big, giant things. Rashad, is there a problem? Okay. I'm just getting a little distracted because I see a hand up on the screen. So I'm not sure if you're raising your hand or you're adjusting your camera or what. Okay. Okay, good. So let's go ahead then. Any questions on that? Okay, good. So let's go ahead then and let's start to take a look at how these reports will look. And again, if we're talking about non-issuers or non-public companies, we will call that report unmodified. If we're talking about issuers are public companies, we call it unqualified. The fact that we have a different name and the fact that the structure of the report will be a little different doesn't change the conclusion that's there, which is that the auditor does not believe that there are material misstatements contained in the financial statements. Okay, so we start first with the non-public company, the non-issuer. Okay, and we can see that we have an opinion paragraph, and they tell us that we are to start with the opinion paragraph. So you look at this and you get through the information, and they tell us what? They tell us that in our opinion, the financial statements present fairly in all material respects. And they start going through the financial position, the balance sheet, and the results of operations. That's the income statement, statement of cash flows, and the statement of stockholders' equity are presented fairly in accordance with generally accepted accounting principles in the United States of America. Okay. Now, what we do then is we start giving, well, what is the basis for our opinion? And we start talking about the fact that we followed what? We followed GAAS. We followed the generally accepted auditing standards. That's how we got to the conclusion here that we believe that these financial statements are fairly stated. Now, it is important that users of the financial statements know that management is responsible for preparing the financial statements. There was a time when people thought that auditors prepared the financial statements. We do not. As you know, we've been saying it is management's responsibility to prepare the financial statements, and we call that out in our report. The auditor's responsibility is to get reasonable assurance that the financial statements are fairly stated, whether caused by error or fraud. Reasonable assurance means not absolute. There could always be some misstatement that our procedures did not detect, maybe because of fraud, maybe they were concealing errors and whatnot. And so we always give ourselves that amount of cushion that it's reasonable assurance. I saw something, Donald Trump, former President Trump, was talking about his financial reports, and he says, well, there's a disclaimer right on the financial reports that they can't be relied on. And I'm like, no, there isn't. There's this reasonable assurance limit, but this is telling investors, creditors that they can rely on the statement. So I don't know why he was saying there was a report on them that says they can't be relied on. The report says they can be relied on, but we limit that to not absolute assurance, but to reasonable assurance. Okay. And then we continue on with a fair amount of detail as to what the audit involved, okay, the auditor's responsibility, what all of our audit procedures involved, and then sometimes our financial statements are contained in another document. The company's financial statements may be contained in another document in the annual report. And just let's take a look here that it is the auditor's responsibility to make sure that the information contained in, say, an annual report is not materially inconsistent with what we know to be the facts looking at the financial statements. So sometimes Management may call out a trend in earnings or something as part of their annual reporting, and they'll have little charts in there and stuff. And we have to read that to make sure it's not materially inconsistent. So if they show profit going up year over year, and we know that profit is actually starting to go down year over year, it would be our responsibility to call out that material inconsistency in our unmodified, unqualified report. Of course, I'm assuming that the financial statements are correct and the annual report is wrong. We don't modify our report for that, but we would have to call out material inconsistency. In this case, they didn't have any, so they said it appears material consistent. And then if there are other things that we have to call out, regulatory requirements and whatnot, which don't happen in every audit, we would call those out here. Okay, now this is the unmodified report for non-public companies. Okay, this is what it looks like. This is when we are in this situation right here where the auditor is happy. Question. Okay, all right, so what starts to happen now if the auditor starts to see that there are some problems? Okay, they didn't necessarily follow generally accepted accounting principles. Maybe there was a disclosure that they didn't provide. Maybe there was a number that didn't pass our audit scrutiny. We think they have overstated, understated an asset, a liability, a revenue, or whatever. And we start to want to call those out. And if those things get really bad, then we will go to adverse. Now, notice, guys, that when you're talking about qualified or adverse, okay, let me bring my pen back. When we're talking about qualified or adverse here, right? We are what? We are on the GAAP side of the scale. These are accounting problems. Something is wrong with the accounting. Okay, those are accounting problems. Let me use a different color for that. Okay, these are accounting problems. We're on the GAAP side of the discussion because we have accounting problems. Okay, so you will see some questions in the final in which I will say, well, under what circumstances would the auditor choose between a qualified or adverse? And the answer is going to be that there was some accounting issue. Accounts receivable wasn't stated correctly. They didn't disclose something that GAAP requires. Okay, so that's when we're trying to choose between qualified or adverse. Means that there is what? Misstatement in the financial statements. We're going to see that when we're on the other side, there's a what? Generally accepted auditing standard issue. Okay, so we start to take a look, and I have this table in here which helps you to remember, you know, how you modify the report when you start to go into a qualification. So this is for the qualified report, and you can see that the title is the same. The address, it's independent auditor. We have to be independent to give this opinion. The addressee is the same. It's going to be the board of directors, the stockholders, whatever. Okay. And then we give a qualified opinion. So we still start with the opinion, but now we call out it is qualified. And notice, guys, we say that what? The financial statements are fairly stated except for, and we call out whatever it is that we are saying is the problem. Okay. They didn't capitalize some leases. They didn't account for the accounts receivable properly. They didn't disclose something. I don't like my buddy's shoes. He's wearing a pair of Air Jordans. Whatever the reason is that we're qualifying, we'll call it out there, okay? And then we'll go ahead and we'll have this section called basis for qualified opinion. And we'll say our opinion is qualified because of the shoes or whatever it is. Management is still responsible for the financial statements. We're assuming here that the auditor was still able to complete all the audit procedures that they needed to. So auditor's responsibility is the same. The rest of this report is the same as a standard report. The only thing that changes is we now have a qualified opinion. We say that the opinion is qualified. We must use the words except for what we're going to describe to you. And then we add a section in there that tells why we are qualifying the opinion. Okay, now you come over and you can see the actual report itself. Okay, let me switch to highlighter for this. I think it works better. And so you can see that we come in, we qualify. Okay, we have the words what? We have the words, where are my words, except for, in our opinion, except for the omission of information described in the basis for the qualified opinion. So we're saying, hey, except for this, what we're about to tell you about. And then we have the reason, and in this case, they didn't disclose something. Okay, whatever it is, guys, they were supposed to put a green elephant on every page of the financial statements. They did not put a green elephant on every page of the financial statements. Whatever it is that we felt they didn't follow on the accounting procedures, we call it out there. I don't like my buddy's shoes, okay? And then we go ahead and we say, hey, we conduct our audit in accordance with the general accepted auditing standards, management responsibility, auditor's responsibility, and so on. The rest of that is the same as what we saw for the unmodified report. Okay, question. Okay, good. Now, if we have an adverse opinion, now we're pinned all the way over. The gap issues are so bad that we're telling you, hey, they haven't followed the generally accepted accounting principles. Now, the title, addressee are the same, but now we give it the heading what? Adverse opinion. And instead of using the word except for, we use a much more pointed word, because of the significant matter. Now, the way I help students to remember, well, should I say except for or because of, let's say you have a significant other and they say, how do you feel about this relationship? And you say, well, except for the fact that, you know, you snore or whatever, you know, I think you're wonderful and I love you very much, whatever, right? Okay. As opposed to what? You're staying with them in that situation, right? As opposed to when you're breaking up with them. When you're breaking up with them, you're saying, because you cheated on me or whatever it is, I'm breaking up. So the because of is what? Much heavier than the except for, right? Okay. Now you come in and we give the reason for the adverse opinion. Okay. They just did way too many things wrong. So we give an adverse opinion. Now, let me tell you something about key matters. Key matters is something that in the auditor's judgment, if they feel that even though they're giving an unmodified opinion, they have to call out a key matter, something that's important, it doesn't change the fact that the opinion is still unmodified, okay? What they're telling to us here is if you've gone so far as to give an adverse opinion, okay, don't confuse the reader with a key matters issue, okay? Forget about it. Just forget, like they say in New York, forget about it. Don't put a key matters because we've seen enough. You're in the adverse opinion situation, don't call out a key matter. Should not call out a key matter. Otherwise, in every other case, except for the adverse opinion, they do allow us to call out a key matters issue, okay? Management still responsible for the financial statement. Auditor is still responsible for applying the procedures, but at this point, the procedure is unveiled that these financial statements are a piece of you know what. All the rest of the report stays the same as what we were seeing for the unmodified case. Okay. Okay, good. And you can see here in this adverse opinion, they use the word what? Because of, or the phrase because of. Where's my because of? I know it's up here somewhere. Right there, because of the significance of the matter, we give the matter has not consolidated the financial statements of a subsidiary. Okay, so that's kind of a big deal. They left out an entire subsidiary, so we're giving an adverse opinion, and then the rest of this is pretty much the same. Okay, we saw the unmodified. Okay, good. What if it is gas issues? Okay, so now we're on the other side of the chart. It's gas issues. It's that we weren't able to follow our generally accepted auditing standards. Just trying to change the pen here. I don't know why. For some reason, PowerPoint doesn't provide a palette of colors. I don't know why, where I can just dip in and out of those. I have to always change the pen and the colors. But anyway, so we sit here and we have gas issues now. Okay, and I'm going to give you questions on your final that will say under which circumstances would the auditor be trying to decide between a qualified or a disclaimer. And it's because there are gas issues, right? We weren't able to apply all the procedures we felt we needed to apply. Those are gas issues, and that's going to be decision between qualified and adverse. Qualified and disclaimer. Qualified and adverse come up when there are what? Gap issues. So the chart works this way. The auditor is never trying to decide between, for gas issues, would it be qualified or adverse? No, that's for gap issues. Okay. The auditor is not trying to decide between qualified, disclaimer and adverse, because they are what? On opposite sides of the chart, right? Okay. Okay, good. So we come over and we need to determine whether we want qualified or disclaimer. When we have some sort of audit issue going on here, we have a gas issue. Okay. Now, what we call these are scope limitations. Scope limitations mean that we were not able to apply all the audit procedures that we wanted to. Okay. And there are different reasons that this can happen. Inability to observe inventory, inability to confirm receivables, refusal by management to provide written representation or to acknowledge its responsibility of fair presentation. This will always result in qualified or adverse. This will always result in qualified or adverse. For some of these other things, like inability to confirm receivables, we might be able to apply an alternative procedure. For example, let's say management says, well, we don't want you to confirm the receivables because it might scare our client. Well, in those circumstances, we could apply alternative procedure. A classic alternative procedure for accounting receivable is to see if the client actually collected on those receivables, say in January, February of the next year before we have to issue our audit report. And if we're able to get sufficient evidence to support what the year-end outstanding balance was of the receivables, then maybe we don't have to confirm those. Inability to observe inventory. We're unable to observe inventory at December 31st because we were hired, say, at January 31st of that next year. But maybe we say to management, well, look, can you count the inventory here at January 31st? And we'll work our way backwards through transactions in January, maybe when transactions are a little lighter because people are done with Christmas shopping and they're not ordering as many goods in because they're trying to sell off, all the stuff they couldn't sell for Christmas. And so there's not a lot of inventory activity. So we back into what the beginning balance must have been at January 1st, then we can apply alternate procedure. But if they refuse to allow us to get the management rep letter. Remember, we talked about the management rep letter in chapter 17. It comes at the end of the engagement. It is signed by the CEO, the CFO. It is a required piece of evidence that if we don't get it, we're either qualifying the opinion or disclaiming an opinion, and we may seriously consider withdrawing from the engagement, okay? Refusal of client's attorney to respond to our inquiry, that would be what? That would also result in a qualified or adverse. So for other issues, the standards kind of let us use professional judgment as to whether something's bad enough to result in a qualified, a disclaimer. In limited cases, the standards tell us this is such a scope limitation that you will qualify, and you're probably thinking about a disclaimer. You should really seriously be thinking about withdrawing from that engagement. Okay. Okay, good. Now, there could be circumstances, scope limitation caused by circumstances. That's the inability to observe the inventory, for example. And again, I probably should have waited till this slide to get into the notion of alternative procedures. But what I'm saying to you here, if you can provide alternative procedures, then it's okay to do those, and you may not have to qualify or disclaim an opinion. Management is post scope limitation. Again, if management has imposed a scope limitation, like that example where I said, hey, let us count the inventory at January 31st, and we'll back into what it must have been in January 1st, and then management turns around and says, no, we don't want to do that. Well, then you say, well, then we're going to have to, and potentially you would have to do what? You may be able to give an unmodified opinion on the balance sheet, okay, because you would see the December 31st year-end balance of the inventory, December 31st of the year you're auditing. Say you're auditing 2022, December 31st, 2022, you're there, you can observe the inventory. The problem is that you weren't there at December 31st, 2021 in this example to observe last year's taking of ending inventory, which rolls in to the beginning inventory of this year. Well, then you're going to run into trouble, because if cost of goods sold is a significant number on the income statement, which it generally is, cost of goods sold is beginning inventory plus purchases, goods available for sale, minus inventory gives us cost of goods sold. Well, I didn't see the beginning inventory, so I really would maybe have to give a qualified or disclaimer of opinion on the income statement. That would roll into the statement of cash flows, because statement of cash flows starts with net income and reconciles to cash provided by operations. I may have to give a qualified or disclaimer of opinion on the statement of stockholders' equity, because I have retained earnings sitting there. And again, that net income number is a pretty pervasive number that affects the financial statement. So if management won't remove the limitation, then the auditor would have to probably qualify or disclaim, depending on the significance of that. And you would need to inform those charged with governance, so they know, the board of directors, the audit committee knows that the reason you're qualifying or disclaiming is because management refused to give you some information. Okay. Question. Okay, good. Now let's take a look and see how qualification for gas issues now will affect the financial statements. And notice we say that what? We have the qualified opinion, its basis for the qualified, and we say that what? Where's our words except for? So notice we use the words except for, but now the except for is not calling out something they did wrong. It's calling out a procedure that we couldn't perform, either because of circumstance or some sort of scope limitation imposed by management. We call out the reason that we are qualifying. Management's responsibility is the same. Auditor's responsibility is going to stay the same. And then we have our other reporting responsibilities, et cetera, stay the same. Now, you come over and you take a look, and you can see that we have the opinion, in our opinion, except for, and under the basis for the qualified opinion, we go ahead and we call out why we qualified. And what do they tell us? A foreign affiliate acquired during the year, accounted for under the equity method, is carried out on the balance sheet and is including ABC's net income for the year then ended. We were unable to obtain sufficient appropriate audit evidence about the carrying amount of ABC's company investment, et cetera. Whatever it is that you weren't able to do, and then you just go ahead and you continue to talk about that you perform your audit procedures, that we are independent, et cetera, but you call out what procedure it was that you were not able to do. Okay, the rest is the same. Now, if we come and we have to disclaim, okay, and you can see that there are some important changes here when there's a disclaimer, okay? So we need to say in our disclaimer that we do not express an opinion, and we use the more pointing word now because of the significance of the matter, okay? Due to the significance of the matter, we are not able to give an opinion, and we are not giving such an opinion, okay? Notice we don't say that we audited, we say we were engaged to audit, because if you're disclaiming an opinion, you were not able to do enough work to even say you audited the financial statement. Do not call out the key matters. So when you're doing the adverse or disclaimer, there will be no key matters, and you talk in your basis for the disclaimer, the significance, okay? Now, auditor's responsibility, and we definitely we'll go ahead and limit very much what we say about our responsibility, because we were not able to exercise the responsibility to a degree where we can even give an opinion. So we're much more careful about how we call out the auditor's responsibility, because we don't want people to be reading about the auditor's responsibility and therefore thinking that we somehow were to exercise that to any extent, because we were not when we're disclaiming an opinion. Okay. Now you look at the example here and we have the disclaimer, okay, and we say that we were engaged. We do not express an opinion, okay, so we're disclaiming an opinion. The basis, why? We weren't able to take the inventories, okay, so here this matter was so significant that this auditor decided to go all the way to disclaimer. Notice the auditor's responsibility paragraph is very truncated. It says, hey, it's our responsibility, but guess what? We couldn't do that. And we don't want to go on and on about what we're supposed to do because we couldn't do it. Okay. Okay, good. Now, that's all non-public company stuff. Any question about non-public company? Okay, good. If we are talking about public company, okay, notice, guys, the report is similar. We have what? We have the opinion, we have the basis for the opinion, and that's it. We don't say a whole lot more. We give our opinion. We have audited the financial statements. In our opinion, they're fairly stated, and we followed, and now we follow PCAOB standards, and we talk about what we did. Very limited. I think the reason the PCAOB wants to shorten this is they want to make sure that the public's concerns are focused crystal on if there are problems. So they've shortened the report. Okay, public investors, they've shortened the report. The thing that I don't like is this critical matters paragraph is required. We have to call out a critical matter. They tell us, it's kind of like, you know, I almost feel like it's your parents, you know, and your parents tell you, get back in there and find something, you know, your parents will tell you that whenever you're not satisfied that you've tried hard enough. It almost feels like that. Like the PCAOB has come out and said, you don't find a critical matters, you lazy bum, go back in there and find a critical matter. And they force the professional, the CPA, to call out a critical matter, even if they don't think in their judgment that it's something that's significant enough to be a critical matter. In the case of the non-public company for the key, and they call it key matters, they let the auditor decide whether or not it has to be in there, unless we're talking about the adverse or the disclaimer, in which case they told us don't put it in because we've got enough problems to worry about. Okay, but you have to call out a critical matters if it's talking about a public company. Okay, okay, good. Other than that, pretty much the same, just much shorter, but the thrust is the same. We're happy. We think the financial statements are fairly stated, and we call this an unqualified. For non-public, we call it unmodified. For public, we call it unqualified. Okay, so you can see the way it will look now if we come in and we have some issues. Okay, so if we have some issues, we use the phrase except for in the opinion section, and then we just insert an additional paragraph. Sort of like the paragraph that was titled basis for our qualification in the non-public company report, but here the paragraph doesn't have a name. It's just shoved in there right after the opinion paragraph so they can read the reasons for our qualification. The rest of the report is the same. So you take a look, and that's exactly what they did. They have the opinion, and they say what? They say except for, okay, except for the effects of not capitalizing certain leases. And then we shove that paragraph in there that says this is the reason that we are giving this. And even though we don't give that paragraph a name, it's the basis for our qualification. It's equivalent to that in the non-public company, but we don't give it that title. And then the rest of the report continues. Hey, we follow the generally accepted auditing standards, and you always got to have that critical matters. Okay. Now, if we are talking about adverse, again, we have the opinion section, and now we're saying because of, and we're giving that adverse opinion. We put a paragraph that immediately follows the opinion paragraph. That's that paragraph we shove in there. It doesn't have a heading, and we start to list all the reasons that we're upset now with the financial statements, why we're crying. The basis for our opinion is the same. We still did the audit procedures. And now when you get to the adverse, okay, we've seen enough problems. You don't have to call out a critical matters. You see how that critical matters thing is a little silly. I mean, they say you have to have it unless, you know, things are going to a hell in a handbasket, in which case you don't have to have it. Well, why did you make me have it when things were good? Now you're telling me I don't have to have it when things are really bad. But I guess they want us to focus on the really bad stuff here. So they omit the critical matters. Okay. And so you can see what the report would look like here for this issue. Again, this is a gap problem. They didn't disclose certain things. And so we're going to sit here and we're going to use the phrase because of. Okay, the financial statements do not follow gap. And we go ahead and we discuss all that. We go through and we say because of that matter. The basis for the opinion is the same. We still follow the general accepted auditing or PCAOB requirements here, and then we don't call out the critical matters. Okay. Now, if we are, okay, what is this? Oh, okay. This is now qualified or disclaimer. Sorry, guys, got a little confused there for a second. This is qualified or disclaimer. You're like, what are you asking us what this is, John? Or your slides? Okay. Qualified or disclaimer of opinion. Now we've got what? Some sort of scope issue. And notice, guys, we still use the phrase except for. Okay, we still see that phrase except for. We still shove in that additional paragraph, but now the additional paragraph is going to do what? It's going to talk about the audit procedure that we couldn't apply. And that's the reason that we're qualifying. And then notice that our basis for opinion, we will describe, hey, we couldn't follow the PCAOB standards entirely. Here's what we weren't able to do. And then we will have the critical matters. So you come over and you can see that we use that phrase except for. I always have trouble finding that. There it is, except for. Okay, then we say, hey, what were we not able to obtain information about? Some investment in a foreign affiliate, whatever. And then we say, except as described above, we followed the standards. So we followed PCAOB standards except for what we've already told you about. And we go ahead and we could still have the critical matters. Okay, now if it's a disclaimer, you're going to notice that it is similar to what we did for the non-public company. We say we were engaged, okay? And then what? Then we say the explanatory paragraph as to why we are disclaiming an opinion. We're not expressing an opinion, we're disclaiming an opinion. And then we will give this basis for disclaimer of opinion, and we will eliminate that our responsibility is to express an opinion because we were not able to express an opinion. We take the paragraph out that says we conducted our audit in accordance because we weren't able to audit, and they get rid of the critical matters when the things are this bad. Okay, and so you can see they disclaimed an opinion, we were engaged, we don't say we audited, we were able to count the inventory, whatever, the basis for our disclaimer, and we say we follow the standards except for what we told you about above, where we weren't able to count the inventory or whatever it was. Okay. Okay, good. Now, sometimes we will want to emphasize a matter that's already disclosed in the financial statements. So what happens? The company follows GAAP. They've disclosed things that we think they should have disclosed, but the auditor thinks this is important enough that I want to draw the attention of the reader to the financial statements, to management's discussion about this issue, whatever it is. Okay. Now, when that's the case, we will put the emphasis of matter paragraph immediately after the opinion paragraph. Okay, so we're going to say we want to emphasize something disclosed in the financial statements, and we'll probably tell them where to find that in the footnote disclosures or whatnot. We use the heading emphasis of matter. We describe the matter, and we tell them, hey, we're not modifying our opinion. We are simply calling out something that we think is important enough to be emphasized. Now you come over, and there are times when the emphasis of matter paragraph is required. For example, if the auditor believes that the entity has an inability to continue as a going concern, what happens? We look at cash provided by operating activities, and it's going down year over year. Well, if an entity doesn't generate cash from operating activities, eventually they're going to go out of business. And if we think that that has a potential of happening within the next year, they may have prepared the financial statements correctly, so we give an unmodified opinion, but hey, it's pretty important that the company might be going out of business. So we do what? We add an emphasis of matter to our audit report saying, see management's discussion about the shit show that's going on here, that they are potentially going to be going out of business soon. And we call that out in our report. If there's been a change in accounting principle, companies can be justified in changing their accounting principle. We are required to call that out in an emphasis of matter paragraph. If there was something that led to a change in our audit opinion from a previously issued financial statements, we would put that in the other emphasis of matter paragraph if it is disclosed. If for whatever reason management had disclosed that, then we would put it in something called an other matters paragraph, and I'll get to that in a second. And if they're following some special purpose framework, like a regulatory basis or something, they're not following GAAP, but we were engaged to give an opinion on some other basis, like a regulatory basis, like following statutory accounting practices for an insurance company or something, then we would call that out in the emphasis of matter, and there would be a footnote that would describe what that special purpose framework was. Okay. Now, there are other times where the emphasis of matter paragraph may be necessary. For example, there was some sort of earthquake or flood or something, COVID that had significant impact on the company's financial reports. Then we would expect that management would disclose that. But if they don't, then we might go ahead and call that out in our report, and management would have disclosed that, I should say, and then we would call that out in our report and tell the user of our report where they could find more information on that. Okay. Other matters come up when you have a situation where it's not necessarily disclosed in the financial statements, okay, but we believe that it is something that is important enough that we're going to call it out in our report, okay? Now, when that's the case, we will include that in our report. If there were emphasis of matter, we would place the other matters right after. It would have the heading other matters, and then it would describe the issue that we have decided should have been put in the disclosures, but we're not. GAAP doesn't say they have to put it, but we think it's important enough that it should be called out in our report. Okay, and they give us different things here. I want to point to a particular one. Let's look at this one right here. If there has been a predecessor auditor involved, so what happens? You audit last year, I audit this year. I am the successor auditor, you are the predecessor auditor, okay? And let's say you decide that you don't want the client has comparative financial statements, but you don't want your report to be issued. Well, I can't force you to issue your report. So what I would do is I would add an other matters paragraph to my report that would simply summarize what was in the previous auditor's report. And I would have to say, hey, it was unqualified, unmodified, it was qualified for some reason. These were the reasons. So I kind of summarized your report. I would put that in an other matters paragraph because we don't really expect, management to be disclosing that in the financial statements in a footnote, because it really doesn't have to do much with the material that's in the financial statements. It's an auditor head thing, right? Where the auditor is saying, well, look, they didn't let me present their report, the previous auditors, the predecessor auditors. So here what was in that report. We would summarize that in an other matters paragraph in our report. Okay. And you can see that there are other times that they give us the option of using that. Okay. To describe the reason an auditor can't withdraw from the engagement, generally an auditor has the right to withdraw from an engagement. I mean, if management is causing enough trouble that you feel you're better off withdrawing from that engagement, you are entitled to do so in most cases. However, if I am legislatively mandated to do that audit, and that's the case with the GAO, the Government Accountability Office, where I used to work, it's written in legislation that the GAO will audit the consolidated financial statements, the GAO will audit the Bureau of Public Debt, and the GAO will audit IRS. It is written into law. Well, the GAO cannot withdraw from that engagement. And if they wanted to, they could provide an other matters paragraph that would describe the nature of how they've become involved, how they've become, connected to this audit. Okay, use of explanatory paragraph for issuers. Okay, so instead of calling it other matters, we now call it explanatory paragraph when we're talking about issuers. And notice, guys, the reasons are very similar to what we've seen. So the real takeaway here is what we're really talking about the fact that the report headings have changed for a public company. It doesn't say emphasis of matter. It's just called an explanatory paragraph, and it's required under certain circumstances. Remember we said that we have to read the other information like the annual report to make sure it's not materially inconsistent. And if it is, we don't have to issue a qualified report. We still issue an unqualified report, but now we add an explanatory paragraph that says the annual report's got some stuff in it that doesn't make any sense. Okay, and it's not consistent with, I don't know, we'd say it doesn't make any sense, but it's not consistent with we know to be the facts based on the financial statements. Okay, and so on. And then they give us judgment as to when we may use it. Question. Okay, good. If there are no questions, then I am not going to take that personally, and I'm going to go ahead and move us to chapter 7. Okay, now what happens in chapter 7? Well, in chapter 7 now, we start to get into issues that are only relevant to public companies. Okay, so what happens? Sarbanes-Oxley gets passed in 2002, and Section 404, and I hear people refer to Section 404 of Sarbanes, and they start throwing all kinds of different things about Sarbanes that are not in Section 404, and they call out Section 404. Section 404 is probably the most known, at least to accountants, because that's where they say that management is required to provide an attestation, not an attestation, an assertion about their internal controls. And they'll say the internal controls provide reliability and financial reporting. And then the auditor is to come along behind and attest to what management has asserted about the internal control. Just like in an audit, management asserts that the financial statements are fairly stated and the auditor attests to that. Well, here, now management of a public company is asserting that the internal controls would provide a reliability in financial reporting. And the auditor says, yeah, I'm down with that. I agree with that in an attestation report. Okay, so that's why I say chapter 7 to now, because I figured, well, we would wait until we talk about reporting overall. to get into this. Okay, so the objective of the engagement under PCAOB standards. Now, look, we could do this for a non-public company, but if we do it for a non-public company, then that's a what? That's a optional situation. Okay, when we're doing this under what? When we're doing this under PCAOB requirements, it is what? It is required. Okay, the entity must have this work done. So this is required. Okay, and that's where we're really going to be focusing our emphasis. You may have a non-public company that goes ahead, a non-issuer that decides to go ahead and have this done, but that is generally because this non-public company is thinking they're going to go public, and they figure they might as well start this process now. Okay, but for the most part, non-public companies would not do this. Public companies are required. Okay, and the objective is for us to express an opinion. Highlighter. Express an opinion on the effectiveness of the entity's internal control. Okay, now we come over and we can see that management's responsibility under section 404 of Sarbanes is to state their responsibility for the internal control and give an assessment. Okay, so they make assertion. They say that we believe that the internal control is, going to provide reliability in financial reporting. Okay, now what happens? The auditor is to form an opinion about management statement about the internal control, and that would be the case also if we were talking about a non-issuer, and they chose to do that. That would be our responsibility. And then we are to look at management's report and make sure that it does these things. Okay, and it should what? It should give an as-of date. If there are any material weaknesses, they have to call it out. And they don't sit on there, waiting for the auditor to find the problems. It is their responsibility to find the problem with the internal control, and they are to work to correct those. Okay. Now, when they provide this report, okay, it could be in a separate or a combined report. Okay, it could be combined with our opinion on the financial statements that we've been looking at, or it could be separate. If it is separate, then the report on internal control needs to, in the other matters paragraph, needs to point to the financial statement opinion, and the financial statement opinion needs to point to the internal control report, I should say, and the internal control report needs to point to the report on the financial statements. Generally, they are combined, but if you don't see them combined, they should point to each other so that the user knows to read both of those. Okay, and they show you here what that other matters paragraph would look like, where we go ahead and we call out that we have audited the internal control. This would be obviously in the report on the financial statements, where we're pointing to the other report, and the internal control report would point to the audit of the financial statements. Okay, good. Now, if we find a problem, and guys, we only have to find one material weakness. It just takes one. What the standards are saying to us is we don't want to mess around. We're not going to play around. We're not going to sit here and say, how many weaknesses does it take to draw you to an adverse? Okay, what the standards are trying to do here is tell you, hey, we have found a weakness that is material, and it is a material weakness if it is more likely than not. That means more than 50% that there will be a material misstatement. Now, if something is more than 50%, what does that tell you? If the chances of something happening are more than 50%, what does that tell you? Gotcha, napkin. If the chances of something are more than 50%, what does that tell you? Okay, good. Thank you very much, ladies and gentlemen, for your attention. I'm not going to continue because I'm not here to talk to myself. So I will go ahead and make note of who is here today so that I know who to give a grade to in the class, and then we're going to adjourn. Okay, I've gone ahead and made note of who is here, and we're going to go ahead and adjourn the class. Okay. All right, guys. I will see you when I see you. Don't forget to take
Why?
the midterm.
What, Professor?
Yeah.
I'm here. We're here still. Is it because no one had
I got
questions?
no response, and I'm not here to talk to myself. So does somebody?
I'm sorry. I agree with that. I just was torn between interrupting or chiming in.
Okay. So what do you think?
It's
Huh?
the sound is now blurry, so I can't hear anything.
Well, does anyone know the answer to my question?
So if something has a chance more than 50%, or is more than likely than not to happen.
That means it's going to happen. Okay. Go ahead. Flip a coin. Okay.
For some-
It's
for some
only
reason-
50-50 on a coin. Flip it 10 times and see if you get heads every single time. I promise you, you will not. You will get what? You will get heads, you will get tails,
Tail.
right? Well,
Right.
if you weighted the coin so that it's more likely that it's going to land on what? Heads than tails, it'll probably land on heads every single time, right? Okay. So if
Yeah.
something has exceeded that 50% threshold, you're telling the user there's going to be material misstatement. And if you see a weakness that can result in material misstatement, then you give an adverse opinion on the internal control. Good. Okay. Maybe you guys were trying to unmute and that's what was going on. Okay. So that's why they say what? The presence of one material weakness results in adverse opinion.
Professor, I keep losing sound quality for some. Is it happening to you? Yeah, we keep losing sound quality.
I can hear you and
Yeah.
somebody else is, I think.
It's been happening for a little bit now.
Yeah, yeah, it's the same on my side too.
Just a minute. One second, guys. I can fix that. I should be able to fix that. I'm seeing, okay. I think it stopped. Okay. Okay, good. Okay, if you want to
Yeah.
unmute, you can. Okay, but I was just going ahead and muted everybody. Okay, so it just takes what? Just takes one material weakness in the internal control adverse opinion. Okay. Okay, good. Now that means, okay, that when we issued the report now for non-public companies, we saw that it could be separate or combined. Same story for public companies. Here comes that same person again. Okay, they muted again. Okay, separate or combined. But if they are separate, they have to point to each other. Okay, and you can see that that would be just put in there without a title if we're talking about a public company. For the non-public company, if the non-public company chose to have such a report, that would be listed under other matters. Okay, and you can see again, and it's the same for public versus non-public, just takes one material weakness. Okay, one material weakness. They don't say 10, they don't say 5, they say what? They say 1. They don't say
One.
1, but a material weakness. Question.
What are the repercussions of this?
The repercussions are that it could affect the company's stock price.
Mm,
If the company was a non-public company and they were looking to attract investors, I mean, it could make somebody nervous to actually go ahead and invest in this company because you're giving over capital to the company and then they've got internal control problems. And if you watch the guest speaker, I think you saw when Danny was talking about not so much the ramifications, but how bad those things can be. I mean, they can be in the tens of millions. And so this could, affect the company's ability to raise capital. If it's a public company, it could start to bring some scrutiny from the SEC. It doesn't preclude them from listing, unlike a adverse opinion would, but it does have ripple effects. So any well-run company is not going to have this situation, and the idea is that if they found something like this, they would be hell-bent to correct this, right?
Understood.
Yeah. They could, we don't talk about it here, but they could do this. Let's say they have this problem. They could call in, and it doesn't have to be the same auditor that is calling out the problem. They could bring in another auditor to say that they have corrected the problem. But when you're called in for that engagement, you are very limited. You can only look at things that were done to address the weakness. So they focus you very much on that. And if you've seen that they've corrected it, then you're allowed to issue a report that says they had corrected a previously called out internal control weakness. So that's probably another thing that a company might want to do if they've had one of these called out. But the idea is that they should be fixing this, right?
Yes, exactly.
Question.
Professor, I'm just wondering, you mentioned that the only public company required to have this section, the internal control report, it's just because of their, like you mentioned, that because of the stock, that because of public interest in their control, and why is a private company doesn't require this section as much?
Well, just let me back up a little bit, fill in a couple blanks there. Under Sarbanes-Oxley, under federal legislation, okay, public companies are required to do that because of interstate commerce. And then the Sarbanes-Oxley Act, that gave explicit authority to the SEC, Security Exchange Commission, to develop audit requirements for public companies, and much how it does with the FASB, where it recognizes the FASB as the standard setter body, it recognized the PCAOB as the standard setting body. And so Sarbanes says public companies will do this, and they will do this work according to the PCAOB standards. Non-public companies, you can't apply a federal legislation to them because they're not trading their stock across state lines. So you can't apply federal legislation to a non-public company. However, the AICPA said, well, look, maybe you have a non-public company that is getting ready to go public or has been asked by an investor, a bank or something like that to get an internal control report, particularly since now it's sort of in the consciousness of folks that there are these kind of reports. So the AICPA says, well, if you non-public company decide to have it, and they've tried to parallel those standards as much as possible. For example, notice that in each case, it only takes one material weakness to result in an adverse opinion. So, I mean, your sense is correct that, well, yeah, if I'm going to be lending you, investing in your company, I want this internal control report. Well, now they're not required to, but there's a set of standards out there as to how that engagement would be conducted. Now, what's
Okay.
irritating, just to cap off this discussion, being a government guy, state and local governments and the federal government are not required to have the internal control attestation. Ain't that a kick in the head? I mean, think about it. It's public funds.
Right.
And the federal government comes down and tells public companies, you'll do this. And many investors would cause non-public companies to do it because they're hearing that public companies have to do it. But when we're talking about public funds, federal, state, and local funds, no requirement to do it. You know why?
Interesting.
Because they're scared. Because they know that if they called out such a requirement, what would hit the fan, because there'd be all kinds of discussion of material weaknesses in internal control that would make me lose more hair, which I don't think I have much to it, lose, and would make your hair stand on end.
Interesting. Thank you.
Thank you for that.
Yeah.
Yeah.
Okay, good questions, guys. Been a pleasure. If you have CPA questions, please feel free to reach out to me. Let me do a quick little commercial for our CPA Applied program. We do have 4 classes that line up with the 4 parts of the CPA exam. You are qualified to sit for the exam within 6 months of completing your bachelor's degree with your 24 accounting, 24 business. Okay, you are eligible to sit within 6 months. So we recommend that if you plan to sit for the exam, that you probably start taking those in the last couple of trimesters before you graduate, so that you can start taking the classes, taking the CPA exam, getting those 1 or 2 or maybe 3 parts out of the way before you graduate or as you're graduating. Also, if you can pass the BEC exam before December 31st, 2023, within the next upcoming year, you should do that, because the BEC exam is going away and they're going to replace it with what they call a discipline exam. And that discipline exam is something that's new. And we generally advise students to try to avoid the new if you can, okay? Because when you're that first group taking that sort of new information that's being added to the exam, you're usually a guinea pig, and there's usually some rocky innings associated with getting through that stuff. So that's my speech about CPA.
Professor,
Question?
I did send you an email. I sent you an email with regards to my qualifications.
Okay. Well,
So
send that to
whenever
me
you
again.
have
I
time, even if
apologize
it's
I didn't
next
get back.
semester.
Yeah, go ahead and send
Will
that
do.
to me again, if you don't mind.
Thank you. And you can answer next month. It doesn't matter, because I'm
No,
still going to be.
send it to me again so it comes up to the top of my inbox.
Thank you very
It's gonna
much.
Get
Will do.
inundated with, administrative, don't forget to do this, don't forget to do that this time of
Thank
year.
you.
So sometimes it gets crushed down.
Okay, good.
Okay, guys, been a pleasure. Have a good holiday. Don't forget to take your final. Okay, that'll open up on Sunday at 12 a.m. It'll close the following Saturday at 11:59. 20 multiple choice questions, 4 points each, and then an objective format question. There are going to be either 4 or 5 elements that are worth either 4 or 5 points. I forget how many elements there are, and it's sort of a matching.
I have a question for the paper that we need to submit. I wanted to do the extra credit because I'm kind of missed few. So what is the point for the extra credit? You
Missed a few
mentioned,
what?
huh?
What did you miss?
The extra credit that you offered during the semester.
Oh, you missed a few other extra credit and you want extra credit to come through the paper?
Yes. So it says 6 pages. So how much?
Yeah, okay. Yeah, give me 6 pages.
Mm-hmm. Okay.
Yeah. And just put in the top of the thing, I'm submitting 6 pages because I would like extra credit. And I'll give you a maximum of 30 points extra credit,
Okay, thank you so much.
maximum. You can't use it to make up undone things.
Okay,
Okay, so if
Fair
you
enough.
don't think, well, okay, I'm not gonna take the final because I'm returning the extra pages and that'll give me 30 points and I already got these many points from the other exam, so I'm gonna back into a C. Don't do that, because then I won't take the extra credit. But if you're taking all the exams and you had a couple of rocky innings on one of them or something, then yeah, and you weren't able to do the other, and even if you were able to do the other extra credits, I'll give you 30 points extra credit to make up maybe some performance on one of the assignments, one of the exams essentially that you weren't as happy with.
Hey, John.
Yes, sir.
Yes, Christian Tujo here. Just a couple of questions. I sat in on the CPA presentation. I did not take a screenshot, but I was there. I don't know if you remember for sure on that, but
Yeah.
I sent a note to you. I just wanted, do you grade those at the end of the?
Submit it and put on there, John, I beg for forgiveness. Put in there, that I wasn't I was attended, but I didn't take a screenshot, and we spoke about this on our final session. No, that should be enough for me to remember.
I did make a remark about the Raiders in the chat, so I was hoping that maybe would spark your memory.
Was it a good point or a bad point?
No, I said go Raiders. They said
I
go
mean,
Raiders.
how did the Raiders go? I mentioned the Raiders in there.
No, he
Well-
did. It was random. I saw it.
Okay, yeah, I just threw it in there just to be funny because I know
Oh,
you're a
because
Raider.
in some of the videos I'm wearing a Raiders shirt.
Yeah.
Oh, okay, I get it. Okay. I used to get teased. They would call me when I was getting ready to make a presentation in a banquet or something. They'd pull me by the shirt, say, John, don't mention the Raiders. Okay. So I thought I had stayed away from that a little bit. Now you look at me today, I'm wearing Niner colors. So
So you're a Bay Area fan then.
I'm a Raider fan. My friends sometimes will be mentioning like a really famous football player to me, and my eyes will go blank and they'll be like, what's wrong? You don't know who so-and-so is? And I'm like, no. And they're like, how do you know the name of the water boy on the Raiders, but you don't know this guy? So anyway.
So do you paint your face and dress up for Raiders games? Do you go to Raider games?
I used to go a lot when they were in Oakland. I didn't paint my face, but I did get shit-faced. I was kind of like a fixture at the Coliseum for a few years there because I went to a lot of A's games. So I came to know some of the vendors and stuff like that, and the bartenders and whatnot. So I was a fixture around the Coliseum for a long time. But what happened, my dad, who's now passed, got sick, and while he was, kind of recuperating that time, I couldn't see myself yucking it up at Raider games while he needed me to kind of be a little closer. And so I would make a point of going to his house on Sundays and watching the games with him. And that just kind of got me out of that mode of like, I'm sitting here with Dad. I don't have to wait in line to go to the bathroom. I'm not dealing with 52 trunks. I think I'm going to go ahead and start to do this. And I guess my story bored him because he logged off.
No.
My
Oh,
story.
no. He probably lost connection.
Yeah, I know.
Professor,
Okay, guys. Anything else?
Last question. On
Yes.
the guest speaker grading rubric page, there's a Stanford email. Does it mean the GGU email
Oh, no.
on there?
No, because I asked my Stanford class to do the same. Just submit it.
Oh,
Mhm.
okay.
Just submit it via e-learning.
Okay.
Don't email it. Submit it via e-learning.
Got it. Thank you.
Awesome.
Question?
No.
All
Happy
right.
Thank you.
holidays.
Have a good holiday. If you
you.
don't talk otherwise, and
Same to you.
keep up the good fight. We'll see you when we see you, okay?
Thank
Thank you, Professor. Happy
Bye-bye.
holidays. Bye.
See you.
Holidays.
Bye.
Bye, everyone.
Bye.